Good afternoon, guys. Hope you're doing well today. Everybody staying warm with the weather? Adjust that volume just a little bit there. Thank you guys for staying with us on this Saturday. Real Estate with Ryan. We're here. We got an exciting topic. Hope everybody got to bed a little bit early last night with that snow, so that was a good thing to see. I know the grocery stores were, were wiped out. So thank you guys for staying. This is Real Estate with Ryan, your trusted source for real estate information in the Knoxville and surrounding areas. And we're always going to bring you the up-to-date information on what's going on in your real estate market, what to do about if you're thinking about buying or selling, and how can we be of service. We've got a good topic today. It's President Trump's tax plan and how will that affect us in 2018 when you're thinking about selling your home, purchasing, or if you're that investor and you've got multiple properties that you're managing or you've got some rental properties, how will that affect the market? Has it changed? Has it not changed? Let's talk about that. I think first and foremost, regardless of your politics, regardless of who you're for, anytime that the government takes less of your money, it's a better thing, right? Who's better off to serve, or who's better off to invest? You or the government? Individuals or companies? And I think hands down, we already know that the government is not proven to be the best with their money. They buy, $32 hammers, things like that, and $2,000 toilets. So if you ever have a track record, regardless of what political aspect you're with, it's very important to understand that more money in our pocket affects the economy in several ways, and it definitely affects the real estate market. But more importantly, when you have more money back in your pocket, you're going to be in a better position. You're going to spend more. It's always about consumer confidence, right? If we have more money, we're confident, we'll go out and spend more, we'll go out to eat more, and we'll do things that will fuel the economy. Whether it's new construction spending that affects the mortgage industry, the title industry, the real estate brokers, Home Depot, Lowe's, you can see they're busy on the weekends, and that's a sign of the economy. People are willing to spend more. We go back 4 or 5 years ago where there's a retraction, we come back in the market, people weren't spending, they weren't going out to eat, they were restricting. Anytime you get in a market where consumer confidence is low, the market is challenged, that affects a trickle down, and that's what you saw. And so that's where some of our inventory was. One of our biggest competitors were the banks. They were taking properties, and homeowners were looking to sell properties with a challenge when the banks were cutting them 30%. And it's hard to compete in your neighborhood when the cheapest competition in the neighborhood is 30% below market value. There's no way you can compete to that, and especially when that inventory keeps increasing. The good thing in 2018, we're not seeing a whole lot of foreclosures. There's still some out there, but they're limited. So that means the normal market is back, normal sales, purchases, and probably our biggest competitor for our sellers is new construction. So that is a good thing. Interesting statistics, stats on exactly this, and I wasn't really sure exactly the numbers, but when I read it, I was shocked. Did you know Americans across the country, 50% don't even pay taxes? So a lot of people are worrying about how this plan is going to affect and come into play in their lives, but 50% of Americans aren't paying taxes. And you say, Ryan, well, how is that possible? How does that even make sense? Well, if you're a W-2 earner, if they take money out of your paycheck, depending on the deductions and things like that, or if you have children or earned income credits or things like that, you may actually get money taken out at the end of the year. You're getting a check back from the government for overpaying. So believe it or not, this affects probably half of Americans, and the other half it won't. But there's some advantages in the marketplace, and there's definitely some advantages that you need to make aware of. But we talk about how money flows and how important that is, and I think that really comes into play with where we're seeing going forward and whether this is a good move regardless of your political. I think it's a good move. I think it's a great move. I think anytime we get less taxes from the government and we can control what we spend for our family, we can reinvest how we want to reinvest. I think the U.S. has always proven to be confident. You're Real Estate with Ryan, your trusted source for real estate information. Just make sure if you have any questions we want to talk about, just call the Pure Magic Hotline, FMNT Insurance Studios at 865-88-TALK. That's 865-888-TALK. We'll answer any questions that you have live on the air, and hope we could help you there. Somebody's on hold. I'm not sure if that's for me. John, is that for me? Okay. Hey, we got a question. Hold on a second. Alyssa, Ryan Coleman, how can I help you? I'll try this one more time here. Hey, Alyssa, Ryan Coleman here. You're live on the air.
Hi there.
Hey, how are you?
I'm good. How are you?
I'm wonderful. How can we help you?
Yes, I'm looking to get my house on the market soon and was wondering what I could do.
That's a good question. And on this market, what do you need to prepare? I think the first and foremost, as we're approaching the spring market, is good curb appeal. Everybody's going to tell you that if you can have the home on the curb appeal inviting, it's going to help you get people in the door. So I'd say the first thing is do an assessment of the house. Obviously, we'd love to come out and talk to you and give you some ideas and tips. And we can also, if you shoot us an email, give you some tips on some pointers of how to prepare it, even if you're not ready right now, but coming on the market in the future. First thing is depersonalize. Go through and do kind of a pre-checklist of the home. Any kind of, loose gutters or housekeeping issues, loose leaky faucets, things like that. Do a checklist that you can do, and then we'll do a walkthrough and assessment, and then give you any tips as well personally, whether it's decluttering, removing some pictures. Maybe we got to go some of the bedrooms, the kids' bedrooms need to be painted neutral. Anything like that will really, really help you. And then let's look at the market and see where the market's going. And I think those are some really good tips.
Okay, great.
Hey, you guys.
For pet owners.
That's a good topic. We have dogs as well, and so it's very, very challenging. You've got kids like us and dogs like us. They're in and out, and so I think the biggest thing. Do you have carpet or hardwood floors?
A little of both.
It's easier with the hardwood floors, right? Because with the pet dander and everything like that, it's easy to kind of do the Swifter and keep things going. With the carpets, before we put them on the market, let's get them steam cleaned. Let's get deodorized, some stick-ups throughout there, and just have it nice and cleaned. And good presentation. Maybe it only takes a couple of showings, and then we can pull it off the market. So, right before we do that, we'll do a steam clean, and that probably should help a whole lot.
All right.
Hey, thanks for calling. Good talking to you.
Thank you so much.
All right, bye-bye. Guys, thanks for calling in. That's 865-888-TALK, answering all your questions. We're going to get right back onto some of the topics on the deduction. But again, going back into flows and how that will help you, I think most importantly, it's a mortgage interest deduction is what everybody is talking about. Do we still have the mortgage interest deduction? And are we still going to be able to deduct that from our taxes? The overwhelming answer is yes, unless on some exceptions. The current exclusion for 2017 is $1 million. Anything over $1 million, you can't write off the taxes. So over $1 million, your loan, the interest is not deductible. That has changed to $750. So going forward, 2018, $750 is going to be the loan amount that you can have and that you can keep on the property and write the taxes off. What does that mean in just kind of basic layman terms? So let's say you had $1 million property at 4% interest. You're paying about $10,000 a year in taxes. And if you're in the 25% tax bracket, what that means is about $2,500 less deduction a year to about $208 a month. That would make sense. So that price range, probably in Knoxville, is not going to affect the vast majority. I mean, the truth is, across the U.S., the average sales price is about $258,000. So the vast point of, I'd say most across the whole U.S. is not going to even be affected. So now your higher end, your luxury properties, that's where it's going to be affected. Your markets like New York, Los Angeles, California, all those guys, well, yes, you're going to be affected. But some of those guys that we're talking about, is $300 going to make a difference in them purchasing a home? Probably not. And if $300 is going to make a difference, you're probably talking about the wrong buyer for your $1 million property there. Let's talk about some other deductions that is also good and not so good. So if you live in California, if you live in New York, so property taxes, real estate taxes are extremely high. So SALT deduction, state and local taxes. Now they're capped. There wasn't capped before. They're capped at $10,000. So your property taxes have a $10,000 cap limit. Let's go through an example of what that means. So if you've got $1 million home, say $1.1 million home, $13,750 in property taxes. That's some property taxes. About a $3,750 write-off, 25% tax bracket. What that equates to is about $930 a year, $80 a month. So if you combine the taxes and the mortgage insurance, you're looking at about $300 a month. So not huge. Here in Knoxville, surrounding counties, unless you've got a couple $1 million property, that is not going to affect you. $10,000 will be more than enough to cover your taxes. So essentially, Knoxville, nothing will be changed for you on your property taxes, and is important. So let's see, this is a big deduction and something that's very, very important. So everybody is familiar with Helocs, which is your home equity loans, and you get them from your credit unions and your banks, things like that. That has changed. We used to be able to do a Heloc, and we could write off the interest and deduction. And so let's say we wanted to add on to a back deck or add a pool or maybe college tuition, we could borrow against our home equity, and we could actually write the interest off. And so that was a pretty good deal. That has changed, no more. Now, if you've got investment property, you can still have an equity line on the investment property. So that's a good thing. So investments are always going to be investments. All your costs are going to be expensed out. And then if you have an equity line on that investment property, that will be able to be used as well. So good news there. Home equity lines, there's some ways around it. And we're going to be talking about that more coming up to the break. So we got a hard break coming up, but we're going to talk about depreciating your investments. You definitely want to stay tuned, whether it's commercial or residential. We're going to talk about the changes regarding that. Capital gains exclusion, you definitely want to stay tuned with that. And then we'll talk about your pass-through entities and how that affects you, not only you guys in the service industry, but also coming up here, if your contractors or investors are holding that. You can watch us every Saturday live here at 11 o'clock. We're streaming on Facebook Live and here at 92.3 Talk Radio and AM 760. And remember, the number is always 888-TALK. That's 888-TALK. And if you ever need us at the office, you can always call us 693-SOLD or visit me at ryancoleman.org. You guys stay with us. We'll be on the other side of the break and we'll pick it back up. Thanks for staying with us.
In the competitive real estate market, Ryan Coleman has a track record with guaranteed results.
Ryan made the sale of our home seamless. He was there every step of the way.
And our home sold the first week for full price.
With his knowledge and expertise, he took away all our worries.
And he got us much more money than we had ever expected.
Ryan is so confident that he will sell your home, he's willing to put his own money on the line. If he can't sell it in the time frame agreed upon up front, he'll buy it himself. Ryan Coleman with Hometown Realty, your home sold guaranteed.
Hey guys, thank you for staying with us on the break here. Let me turn that down a little bit. And what we were talking about, where were we at here? So I don't have my lovely co-host today, April. She keeps me on track. So you see me, everybody knows that. Yeah, there we go. Good job, John. Keep me track. So we're talking about the $750,000 limit and what that does for you. So essentially, that should be unchanged. So if you're residential, whether you're moving or selling, transferring in Texas, that should not affect you. And, unless you're going luxury, but those guys in the luxury market probably should not be affected too much regarding that. Let's talk about depreciating investments. This is a really good one and has also really helped us regarding commercial and residential real estate. So the current law is how we are now. Again, current disclaimer, I'm not a CPA, I'm just a real estate guy. But from what our research we're gathering, what we could find, and then what we can relate to you, I always encourage you to do your own, get with your CPA, and they can help you guide you through this. But this is kind of our 101 on this and what we see and kind of our information and kind of just the highlights. And we'll also have some more of this information posted on our Facebook and our website that will help you, that you can download and go more in depth to. Okay. So currently, commercial property is depreciated over 39 years, and then residential is 27.5. What does that mean, depreciation? So as an asset, over time, it depreciates in value. And for a tax advantage, that's why we always encourage you to own residential real estate or commercial real estate, is because it allows you to affect the tax bracket. It's one of the greatest investments that you can make and defer taxes if you're making money. So regardless of your statute, it's a good idea to invest in real estate. And they've even made it bit better in 2018. So commercial, larger, more expensive, they could stretch it out for 39 months. Residential, 27.5. New law, 2018, residentials went down by 2.5 years to 25. Now here's the big one, commercial guys, to 25. Now what does that mean, layman terms? What that means is commercial going from 39 to 25 means it's forcing the depreciation down at a greater accelerated pace. Meaning, bottom line, you're probably going to get more depreciation off your taxes, which will mean come off your basis, which will mean less money that you pay to the RS, and that's always a good thing. So Uncle Sam will get a little less money, you'll keep more of your money, and you'll be able to depreciate that building on a larger scale, at a quicker scale. Now, my wife and I were talking about this last night, and we talked about depreciation and how that affected. And so let's say you had a 25 or 30 year mortgage on the property. Essentially, out of 25 or 30 years, you will have bled out the depreciation. So you have to keep that in mind. But at the same time, you still have expenses that you could depreciate, rents, property management, fees, taxes. If you have a mortgage on the property, that's an expense. So the difference on your primary residence and investment property, investment, everything is an expense. You know, it's income producing property. There's restrictions on your primary residence. And so that makes a big difference as well. It almost equals, I'd say the difference is about a 60% difference in appreciation or depreciation on your property on the commercial. There's not a big, 2.5 years is not much on residential, but there is still advantages there. And, every little bit helps, and that is going to help you if you have that rental home or that summer home to do that. So capital gains, that's big. We help everybody that's buying or selling. So everybody understands the current rule where we're at now. So the rule now, if you don't know, let's kind of go over that. Capital gains means if you've lived in the home for 2 years out of 5 years as your primary residence, when we go to sell your property, we go to Carlette, Genesis Title, and we do the closing. You've got this form that you fill out, and it's called basically it's 1099, where it reports to the IRS, and they track how long you've owned the property and whether you're going to pay taxes on your gains. And so the title company actually sends what your net proceeds are, so Uncle Sam knows exactly kind of a 1099 what you're able to get. So 2 of those 5 years, if you're a single couple, $250,000 is exempt. Married, $500,000. They fought really, really hard to possibly take that away. There was a lot of talk about changing that from a 5-year to an 8-year. That would have been devastating. Let me tell you why. So basically, recap, they have not changed it. Still $250,000 single, married $500,000. So if you're thinking about selling and you've lived in your primary residence for 2 years, you don't have to worry. There's going to be no tax on it. But they try to change it from 5 to 8 years. Let me tell you how that could affect the economy, how that could affect where we're at now. Right now in the Knoxville market, well, across the U.S., the housing inventory is down 7 to 8%. Every market is different, but there's a little bit less homes out there now than it was prior, meaning there's more buyers, less inventory. If you're thinking about selling and it's not a must move and you needed to move in the next couple of years, if you were going to pay taxes at an average tax bracket anywhere between 25 and 30% range, somewhere in that range, you may decide if you were going to pay taxes on the sale to wait. Now, if you wanted to wait on a market that's already lower in inventory, that just creates more problem. So it's not really adding to the solution. It actually would probably stifle the economy, and really we'd see a big difference on people that are, whether it's estates or different things like that, or your single residence, or maybe it's a downsize. That downsize doesn't have to happen if they're paying taxes. We help so many seniors that are doing that, and they just can't afford to have that tax hit. So they didn't do that. They tried to do that, and I'm glad they didn't do that. So recap on that is just nothing's changed. So that's a good thing. Now this one, I'm not 100% up to speed on it. It's a little complicated. So again, disclosure, check with your CPA. But the next topic is service provider pass-through tax break. Service provider, who are those? Those are your engineers, real estate guys, athletes, movie stars, anybody in the service industry versus LLC corporations, pass-through entities. If you guys own some real estate, investment property, and it's more than likely for not only tax advantage purposes that you've got it in an LLC, or maybe you've got it into an S corp, or you could have it in your sole proprietor name. The advantage on this is that it's broken into two prongs, and I think to make it as easy as possible, they're allowing for the LLC and the corporation still to have that pass-through entity, all right? So really nothing has changed there, but there's an additional 20% with some exclusions, okay, if you meet that investor criteria on investment properties, that you can avoid the self-employment tax and get the extra 20%. So it's it's broken out into two phases: service industry, and then your LLC, your contractors that have properties there are two categories. It's a little confusing, but basically the LLC and corporations, you still avoid the self-employment tax, and then you still get a 20%, but there's no income restriction. We go to the service industry, and don't quote me to the exact number, but for a single individual, married is 300,000, singles about 157. Okay, again, don't hold me to the exact number. I think it's 157 for single. So what that means is, as long as you don't make more than that, you'll get an additional 20% off your basis. So, for example, if you made $100,000 and it was passed through entity, you're going to automatically get 20%. That's so you're going to pay tax on 80 grand versus 100 grand, and so those are big numbers coming up. And so I think regardless of where you look at it and where you go through the plan, overall, I assess the plan. There's a lot of good stuff. Some things won't be unchanged. Some things will not affect the market where we're at today, and it will overall assess and help the economy. I think the average individual is going to be about about 1,000 to 7,000 a year that it could affect. Overall, we give it an A+. There's obviously some things that need to be changed, but I hope you're enjoying the show today. This is Real Estate with Ryan. The time has flown by. I know we got into the weeds and technical, but stay with us every Saturday, 11 o'clock. We appreciate you joining us. That's Talk Radio 92.3 AM 760, and you can always reach us at 693-SOLD or ryancoleman.org. Thanks for staying with us, guys, and we'll talk to you next week.